Ahoy there, traders. How are we all doing? How are we all doing? Just pop a comment in the chat box. Let me know that you can hear me. We're all loud and clear. Hello, Randall. How are we doing? There we've got Adrian, Dawn, Emily, Ian. Hello, Ian. John, John 2, John 3, Nick 1, Nick 2. Got a few people with the same names. Hello, Ron. Hello, Rob. Hello, Stuart. Hello, Scott. Hello, Vito. Awesome. Full house today. Full house. So for the eagle-eyed people among you that attend these sessions regularly, we've got the same image this week. Despite me usually recording, it didn't record. So I'm going to have another go. I had a few requests to go through something similar. So it just allows me to make sure that the record button is definitely pressed this time. We're going to take a little bit of a look at some of the research that I've been doing recently. It's one of those things as a trader and trading, doing this long term, you'll always have a little research project bubbling along in the background. On a personal level, I find that keeping idle fingers busy is one of the untold secrets to success. It's one of those many untold secrets to success. For me personally, I had an issue many years ago now with tinkering with trades, not letting them do their thing, wanting to move stops, move entries, move targets, and just generally dicking around with my trades. So one of the ways that I combated that was to always have a little research project. And, you know, fast forward 27 years, you know, you're looking at the culmination of, you know, my life's work, which is, you know, I never thought I'd hear myself say those phrases, but nonetheless, when you're young, naive, and full of more excitement than you care to share, it's a weird thing to look back on. You know, a long career doing this. Anyway, idle fingers, keep them busy. One of my pursuits is to not necessarily automate, although I want to have automation. And there is a distinction. I don't want the computer to trade for me, because I do believe that there's certain elements that just can't be coded. We can mechanize the decision, which makes it a systematic process, a series of yes or no questions. But sometimes just that visual confirmation, which is a big part of my own process, is, does it look like I expect? And if the answer is no, I can't code that up. You probably could. I mean, I just don't know how to describe it to the programmer. But nonetheless, what we want with any trading plan is a series of yes or no questions to help us make not just a decision, but consistent decisions. And that's really all a trading algorithm is. It's just a series of yes or no questions that help us come to a conclusion to trade or not to trade, as the case may be. So that's what we're going to explore. We're going to look at it. We're going to look at some of my research. We're going to look at some actual automations that I tend to use as research assistants as opposed to 100% automation, although they're coded up in a way that they could be completely computer traded. So technically it is an algorithm in the classic sense. Anyway, that's the schedule, the agenda for all the new people today. We usually spend 20 to 30 minutes and up to about 60 minutes in these sessions. We're going to have a little look at the markets. And as I've just alluded to, we're going to look at trading algorithms, assistants or automated traders. You know my view. I tend to use them as an assistant, but we can go and look at them anyway. For those of you who don't know me, my name is Phil Newton. I'm just going to spend a few moments talking about who I am. I'm not a Wall Street guru. I've not worked in the city. I'm not going to pretend to blow wind in anyone's sails that I'm, you know, any better than anyone else. I'm just a regular guy. I did crack the code on trading, as I've just mentioned. I want it to be simple to replicate. I want it for myself first, but it turns out that it's really useful for other people, especially newer traders and experienced alike, to be able to replicate the types of results that I've seen. And again, I'm just a regular guy. I enjoy helping people. It's why I do these types of sessions. and just make what I do a little bit more accessible to everyone else. So I've been doing this full-time since 2001, hand-drawing charts in the early 90s, calling most of my trades out in real time since 2004, managed private clients' accounts, ran my own fund with assets under management of 10.3 million. I was doing the numbers recently. I've coached thousands of students with my programs. I've actually personally mentored 756 traders. And that number, it kind of astounds me over the years, from retail traders through to hedge fund owners, banks, institutions. I've been around the block a few times, is all I'm really trying to say here. The one thing that is universally true is I am obsessed with helping traders replicate the types of success that I've been blessed to have. And without further ado, let's go and look at trading algorithms. Let's take a look at the market overview first. I'll just minimize the slides. We'll come back to those later. Where are we at? It's an algorithm. The algorithm I like to use at the moment is moving averages. It's the lens that I look at the charts. The tool doesn't matter. As we've said many times over the years that I've been doing these free weekly sessions, is the tool of the trade doesn't matter. We could be looking at Dow theory, GAN theory, Elliott wave theory. We could be looking at moving averages, stochastic, CCI, RSI, ABC, QR. It doesn't matter. Just pick a tool. Just pick a tool. It doesn't matter. Whatever you like, that's the one that you should use. That's the one I chose. If we were doing this 3 years ago, we would have been looking at Bollinger Bands. Doesn't make any difference. We're going to find the same thing. The trick with all these things, with all these tools, and there's hundreds, if not thousands of possible tools that we can use, or indicators is another way of saying them. I don't like using that word because it suggests something more than what it actually is. It doesn't actually indicate anything. It's our interpretation. So what I want to do is I want to use them as a frame of reference, a lens to focus my attention. And as we've seen many times before, I'm looking for the average prices to be crossed, which is over there. That's going to give me a mechanical directional bias. And then we want to make sure that we're in that trend for about 40 days. We want to also see that we're going up about 20+% in that same time period. And really what we're doing is we're looking back over sort of 60 to 90 days and saying, you know, is this instrument that we're looking at actually moving? And if those three things are true, we can say that we've got a trend. And that's at a mechanical level. And as most of you know that have seen me do this for any length of time, I'm doing that all over here on the left. That's what these little red and blue boxes mean. Red, 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 blue, 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 red, 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 blue. That's what they mean. It's telling me that that row there, we're looking at the S&P. So that top row, blue, 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 everything's above the moving averages. So right now we're above the moving averages, blue, blue, blue. We've been in that trending state for more than 200 bars. That's what that number is. Excuse me. And we're in a trending state. On this layout, I've not got, are we going up? We could equally add a column. And you've seen it on some of my other layouts where it tells me like, how much are we up over the last 60 days? Is this instrument actually going up? In fact, let's go and look at it. Let's go and look at it on the other one. So this column there, so this is telling me like, what's this stock doing? Is it going up in the last 60 days? So I can see all of this information at a glance. And that's kind of important. Because if I think about the overarching flow, the overarching production line that I keep talking about to each and every one of you every week is, where are we? I've got a new fancy slide. I want to show it off. There we go. The overarching process that we want to aim towards is this step one. That's what we're looking at right now. I want a mechanical reason to take a big list of opportunities down to a small list of opportunities. But equally, as we're talking about right now, is I can use this to, when I go and look at the chart, to visually analyze the charts. And that's what we're doing. We're using the same process to scan and to filter, to look through this lens of like, what's this stock doing? What's this instrument doing? And it works on any market, any time frame. And this is the overall production line that we talk about. I've actually taken it down from 4 steps to 3 steps because I repeated myself twice. But we're looking at this mechanical scan. We want visual confirmation. And then we're looking for the trade management elements. They're essentially the 3 steps. We usually use Twitter as our example. In fact, let's go and look at Twitter. Where is Twitter? Oops, a daisy. Just pressing the wrong button. TWTR. So we usually use Twitter as our example, but we could be using the market, the index, the S&P, whatever we want to look at. So our model is average prices going up or crossed up in trend for 40 days. We're actually going up for at least 25% in that same period. And obviously we've been going up longer. So we're clearly up in the last 60 to 90 days as well. And then step number 4 is we're looking for one of these yellow boxes. Again, I've manually placed these, but this is a retracement. I'm looking to buy, if we're determining that price is trending, I want to buy the dip. And all we're doing so far is I'm trying to define what that means to me. And we could be using Bollinger Bands, we could be using MACD, we could be using stochastics, we could be using percentage R, we could be using any of those tools, Dow3, GAN3, LOA3, all the other theories and tools and indicators and widgets and whiz bangs. It doesn't matter. But what we're doing, whatever tool that we use, again, in this case, moving averages, I'm just using them as a lens to say, okay, well, what's this opportunity doing? What's this opportunity doing? Is it going up? Is it going down? Is it going sideways? And again, in the context of what we're doing, we're trying to evaluate, like, what's the trend? Is this opportunity trending? Again, I'll work on any time frame. Let me just inset the 60-minute chart here. So we've got the 60-minute chart, just blown that up to full screen. So we can see right now the average prices have crossed over. That little red bar there, that was the presidential news, tax hikes, and all the announcements that came out there. But we can see that the average price has crossed up over here on the left, but prices below the 50-period moving average. There's our retracement that we're looking for. So we're looking to buy the dip in an uptrend. That's what we're doing. And we can see the same things, the same principles on a 60-minute chart. And what I'm trying to illustrate is it doesn't matter what the time frame is. If you want to day trade, if you want to swing trade, if you want to invest, the same principles can be used across many time frames. Which one is right for you is going to depend on what your personal objectives are. If you want to get paid at the end of the day, the end of the week, the end of the month, the end of the quarter, that's your objective. Your money is a byproduct of the process. So like how fast do you want to do things? Again, if you've not got time to day trade, there's no point you learning how to day trade. It really is no point doing it. But if you'd rather have a more leisurely pace, if you want to get paid at the end of the week, then maybe you can look at a 60-minute chart. If you don't have time to do that even, then you're going to be looking at the daily charts. So you're going to be getting paid at the end of the month or the end of the quarter. And that's usually how I describe it to people. So same process, same principles, they'll work on any time frame, but it just gives me this framework, this structure to say, okay, well, now that I know that I'm looking for, again, in this case, we're on the daily chart. So we're thinking about swing trades. We can start using these average prices. So we've got the 200, we've got the 50, we've got the 20. And we can start looking at them in the as a way to apply some structure to the market. And all I'm going to use them for is as a frame of reference. Where is price right now in relation to the tool that I'm using? And in this case, we're looking at 3 moving averages. So where is price in relation to these moving averages? And you'll notice that there's no trend lines, there's no Fibonacci, there's no all of the other widgets. We can use all of those. But what I tend to find is that there's a lot of correlation, there's a lot of overlap. And this is why I keep saying the tool doesn't really matter. Just pick one of them. You're going to get a similar approximation with Bollinger Bands. You're going to get a similar approximation with stochastic. You're going to get a similar approximation with MACD. You're going to get a similar approximation with the Dow through, the GAN through, the LOA through. You're going to get something similar. It's not going to be exact, but it'll be similar. So pick the tool that you like. When I first started out, I did patterns. I was really drawn to geometric shapes, the triangles, the head and shoulders patterns, the Gartley patterns, and all the other fancy names. And I was attracted to those. So I started out looking for what is essentially consolidations and trading breakouts. So for example, I started off looking for this type of pattern and then trading the breakouts and then trading the trend after the consolidation. That's what I started out doing. And there's no right or wrong way of doing it. It's just what I was drawn to at the time. You fast forward 27 years, I trade a little bit differently, but it's got structure. That's really what we're doing. So how do I know that this works? And this ties into the algorithm. So is this just something that only I can do? Is it something that I'm drawing on my 27 years experience or any of the other things. But if we start to think about, we've got the average price is crossed up, we're in trend, visually it's going up. And if we wait for that step number 4, we're down 10% in 10 days. Anyone can do that. We're waiting for price to be down and retracing below the 20 or below the 50 period moving average. And when you do that, there's only 1, 2, 3, 4, 5 opportunities to trade, to buy the dip as we've defined in relation to the moving averages in the last, well, since last August. Does that make sense? Let me just pause there. Does that make sense? I'm going through the back of the envelope version of this just for speed, but there's 4 elements to this. Determine the trend and buy the dip. That's what we're doing. And all I've done is used moving averages to define what the trend is, what the criteria that I need to see, and then what does a dip, what does a retracement mean to me in this context, in this structure? Does that make sense? Let me pause there. Let me pop a little comment in the chat box. Let me know we're all on the same page. Yes, you get it. No, you don't. Just let me know if this makes sense. Which is code for Phil's going to take a quick slurp of his tea, as you can hear me chugging along in the background. Cheers, Jason. Thanks, Nick. So that's all we're doing. That's all we're doing. Now, the question then becomes, like, how do you know it's going to work? How do you know it's going to work? How do you know that this is the one? I don't know that this is the one. What I can do is, because I can mechanize these decisions, I can start to plug that into an algorithm. See how we tied that back? So I can start to plug this process with those rules and create an algorithm. I can tell the computer to go and find those things, go and find those items. Now, visually, just changing the screen, visually, I can see all of those things that we've just described on the left here. So I've got a bullish box here that says the average prices are crossed. I've got a number that says how many days we've been in a trend. And then I've got 3 smaller boxes, the top row here that I'm just marking off, blue, blue, blue. The current price on that row, which is Apple, is they're all above the moving averages in a bullish trend. So you would have to presume that it's rallying in an uptrend. That's what we're looking for. So I can do all of that scanning on the left. So I know how to scan for it. And we've spent a lot of time in the last several weeks like explaining this scan and this process to you. And a retracement might be row number 11 here. Let me just try and highlight it so it's easy to spot. Just there, that row. Just a little sidebar. If you're on Zoom, you can zoom in and out. So if you can't see it on the full screen, you should be able to take it off full screen, and you can pinch the screen if you're on a mobile. If you're on your desktop, you can manually select the zoom and zoom in and zoom out. So you can kind of take a closer look if you've got a small screen, is what I'm saying. So CNX, so we can see that we've got a nice bullish trend. It's up 46% in the last 60 to 90 days. It's been in a bullish trend for a while, and right now it's below the 50, below the 200, and that's why it's got red, red, blue. Red, red, blue. That's what we're looking at. I'm just looking at that there. So I can zero in on a retracement in an uptrend. Still might not know that it's a good trading opportunity, but that first step, the mechanical reason to go and look at the charts, is right there. So let's go and take a look at it, just so you can kind of see how quick and easy it is to find. So now visually we can see it's crossed, it's in a trend. Visually it's going up, and over more than the last 10 days, actually, it's retracing in the context of an uptrend. Great, that looks fabulous. It's not the best candidate I've ever seen. Let's go back to Twitter, which is our model example that we've been using over the last few weeks, but it allows me to find the dip and define the dip, the retracement in the context of an uptrend. Let's come back to the question. How do I know that it works? Because not all stocks are made equally. Now, this is where having defined rules, precise rules comes in. It means that firstly, you can backtest manually, because there's no ifs, buts, or maybes that as we've defined it, a retracement has happened. And we can start to apply rules for management and entry and tactics that are equally as mechanical and plug them into a series of yes or no questions, or a series of yes or no statements. Has this happened? Yes or no? If yes, move to the next question. Has this happened? Yes or no? And I don't know if you can just see it on my chart, but we've got a few little teeny tiny arrows. We've got some dotted lines. I've got my little algorithm just working along in the background. So what we can do is we can actually plug those rules into a series of yes or no questions and say, okay, computer, just like it says Star Trek, computer, backtest Apple over the last 20 years, 30 years, 40 years, however much data that you've got on a daily chart, and let me know if it was worth trading. So this is, I'm not curve fitting the data. Again, it's a long conversation for another day, but basically curve fitting is you're looking for the perfect entry setup, the perfect opportunities, basically you're making the most of the data that you've got. So that's what curve fitting is. So what I'm doing is I'm not curve fitting. I'm not looking for the perfect entry. I'm looking to see, do I have a smooth equity curve? I've been trading this manually since 2001. I've been using a version of this strategy for over 20 years. But what I'm able to do with automation and power of computers is to validate the rules. Does it work on Apple? If I just carried on trading blindly Apple over the years, we've got a lovely steady equity curve. That's all I'm looking at this stage. Do we have a nice steady equity curve? So then it means that we can start asking the question, not only validate the strategy, and this is why I keep referring to these automations as more of a trading assistance. I could just let the computer trade this and go and do something else. That's one possibility. At a personal level, I don't think I'm there yet. I'm not there. But what we can do is, at the very least, we can validate the decisions. If I had traded every possible setup as we've defined, buy the dip, sell the rally, when price is trending in the criteria that we want, and then it rallies and then retraces, rallies and then retraces, you should make money. Now, then this then becomes like, well, if every stock, because there's like 27,000 stocks, and we've commented on that not all stocks are made equal. I don't want to trade penny stocks. I'm not trading pump and dumps. I want stocks that ebb and flow, because if I'm going to trade the trend, I want stocks that trend. And I want to see them consistently ebb and flow back and forth, up and down, so that I can profit from them. So that means that I can start using not only this algorithm, the computer, to validate the strategy that we keep talking about every week. I can also start using it to say, okay, well, which stocks are better? Which stocks are worth my time trading? So a quick illustration, because not all stocks are made equal, I've just got a few examples of stocks that are not great. Again, my top universe of stocks, they're stocks that have stock options. They are traded. They have an average of 1 million shares traded per day. They've got a beta of greater than 1, meaning that if the S&P moves $1, then the stock will proportionally move a similar amount. So it moves either more than or greater than the S&P. So I want stocks that have a little bit of oomph in them. So that means that I'm not trading penny stocks. I'm not trading low floats. I'm not looking for pump and dumps. I'm looking for stocks that have a historical tendency to ebb and flow, to trend for 2-3 months up, 2-3 months down. It can still be in a consolidation, but it can trend from the low to the high to the low. It ebbs and flows back and forth. So what I'm able to do is to take my master universe of stocks, everything that I could trade that meets those requirements. They're liquid, they're tradable, they've got options, they've got their bid-ask spreads that are reasonably narrow. I can take that universe and say, hey, in the last 20 years, was it worth trading this stock? And what we can see here, I don't know if you can just see it in the inset, the bottom left here, is we've got an equity curve that's negative. There's the horizontal line there. We've got an equity curve that says, you know what, it probably wasn't worth trading this stock. So not only can I validate the strategy, the rules, the algorithm, the series of yes or no questions. I can also start to say, well, what should be in my universe of stocks? So very quickly, I can just skip down and say, nope, not worth trading this one. Nope, not worth trading this one. Nope, not worth trading this one. And I can start to have an expectation of, well, if I put this trade on this stock with this strategy, what's my probability? I can start looking, again, just going back to Apple, I can start looking at the numbers and saying, okay, well, on average, the total number of trades on Apple, again, without looking at the dollar amounts, it's not really that important just for the way that I've coded this up. 48% of trades are profitable. 55 of the percent of trades are bullish, are profitable. Only 20% of the bearish trades are profitable. Okay, so maybe I only trade Apple long because 55% of the time I've got an expectation that I'm going to make money. Now, I don't know if you know, that sounds like a coin toss. That's pretty fucking good. That's amazing if you think about it in the context. If there's because there's not two things that a market can do. It's not as binary as up or down. It's up, down, or sideways. Because the stock there's actually three things that it can go up, it can go down, or no change. There's three possible outcomes. Now we'll call no change oscillating, ranging. And which is what, to be fair, which is what Apple's doing right now. It's just meandering sideways. It's oscillating sideways. Now, if we can identify that, again, this is where the visual inspection, this is why I can't completely let a computer just trade for me, because I can filter that out manually with my step 2 of my production line process. So when we go back to all the rules that we have, not only are we mechanically evaluating, mechanically assessing, is it worth it? We've got a great universe of stocks. I can filter a lot of the noise, and some of that, not all of it, some of it, I can filter it out by saying, does it look like I expect? Does it look like the label? I'm looking for a trending stock. And right now I can see, you know what, maybe I just wait. Maybe I can just filter some of these, because this is clearly ranging. Maybe I wait for a breakout. And that's what I can't quite code up in a perfect world. It probably can. I just don't know how to describe it to my programmer, but that's why I've got this visual step. So I know that this equity curve is probably going to be a little bit steeper, a little bit smoother. But ultimately what I can do now is I can say that I can validate not just the strategy, but what stocks should we trade? If we go to, again, American Eagle outlets, we've got a great smooth equity curve. We've got equity curve making higher highs and higher lows. And this is over a 20-year period, 20 years data. So it's not an isolated instance. So when we can find good stocks, good companies, stocks that ebb and flow, that profit in up and down markets, the ebbs and flows back and forth, is it worth my time trading this stock? I can validate it. If I wanted to trade for example, 3D systems, is it going to be worth my time trading it? Yeah. In the last 20 years, it's produced a reasonably steady equity curve. Great. So the next time that it sets up, which is, in fairness, it's not now. It's below the 50 period. It's above the 200. It needs to go back above $30. It's nowhere near it right now. But when it does, that could be a great trigger because there's a high probabilistic expectation that it will produce a result. More specifically, if I go back to the trade performance, there's 40% of the bullish trades turn out to be profitable. That's a pretty good expectation. I like those odds. Does this all make sense, folks? So what I'm hopefully starting to illustrate to you, it's not just me saying that buy the dip makes sense. And it's not just me saying buy the dip on this universe of stocks because Phil likes them. I'm not playing favorites. I don't care about the name. I'm validating the strategy for you right before your eyes without curve fitting. If you just follow some basic rules, look for the trend, trade the trend, we've defined the trend, And you can see there, I mean, this is Logitech. To be fair, I'm a fan of I quite like the fact that Logitech's on my list, on my exceptional list. So I've got a dozen stocks there, 2 dozen stocks there that are exceptional. But I am a fan of the products on Logitech. But we've got a great equity curve. Again, it's not just because in the last 6 months, the last 8 months, that stocks only go up. Ha, ha, ha. You know, diamond hands and let's buy the next meme stock. These aren't meme stocks. These are stocks that have been going around for a long, long time. They consistently produce results. In fact, let's go and look at a meme stock. Let's go and look at GME, GameStop, GME. In the last 20 years, what would GameStop have done? We've got one big spike there. One big spike. That's it. Back in the early this year. This was never on my radar. Never on my radar because it's not worth my time. So why didn't I trade GameStop? It's a pump and dump. It's a meme stock is the popular name. It's a low, or at the time it was low float. It's one step away from bankruptcy. Even now, it's one step away from bankruptcy. It got ramped up, but it was never worth my time. Never worth my time. What's the other one? Was AMC was the other one that hit the news? This is another one. Was it even with the pump and dump? It's probably not worth my time. I think there's a little bit of an anomaly there, but I mean, visually we can, there might be a little bit of a rogue tick there, but you know, to be fair, it actually starts below the moving average. It's only just crossed over. So it's actually accurate. It's not worth my time trading. And this has only been, this has got data from 2013. So hopefully you can start to see that we want to pick not just any stock. And this is one thing that I've always said, we want to pick good stocks. So what do we quantify as a good stock? We want them liquid. We want them active. We want them historically trending. You know, short-term trending, you know, we want stocks that trend for, you know, 3, 4, 5, 6 months up or down. And that means that it's going to be a great trading stock. So this gives me a universe of stocks that on this particular tab, it's maybe, what have we got? We've got 100 stocks. Would you like the top 100 stocks that consistently produce results from trading the trend, as I've been describing to you these past several months, buying the dip, selling the rally, using the average prices to help you figure out, is it trending? Is now the time? Are we ready to dip? Are we rallying in an uptrend? Okay, leave it alone. We've got a nice structure, a framework. A good example of on NVIDIA. You know, we can manually see that in the last 6 to 8 months, it's in a range. So we can avoid all the times it kind of goes above. We can avoid all the times. Now we've got a breakout. Something new is happening. So now we can start to participate in that buy the dip. And that's that visual inspection that we can do there. So we can filter out some of those losses as it's meandering sideways. And again, even despite that, we've got a lovely steady equity curve that's been going up and up and up on a long-term, multi-decade basis. So you should be able to see that you've got a reason to have a systematic approach to find, filter, and sort stocks, a systematic approach to find and put those opportunities in front of you on a daily basis. We call that 4 steps, the 4 stages of the trend, the buy the dip. We've quantified it as 4 steps. So the only question is now is like, what's holding you back? Why aren't you doing it? You know, we've got a system, a process that's methodical. We've now got a universe of stocks that we've validated that over the long term, these are the best candidates, the best stocks on a daily chart. And I could do the same thing on 60-minute charts, 10-minute chart, 5-minute charts, and let the computer do the heavy lifting and say, which are the best stocks that provide short-term, get paid at the end of the week on a 60-minute chart trend. I can do that. I can find that. It takes a little bit of time to kind of get that universe. But if I start off with these top 100 stocks on the daily charts that are great, I can see if they're worth my time trading intraday if I wanted to do some short-term trading. But I've got some great candidates that are worth my time. And this is how I like to use, let me just turn that off. This is how I like to use algorithms, automations. don't quite want to let the computer trade. As I keep saying, I'm not there. But what I want to do is I want to use it as an assistant. We've validated the trending strategy. We've validated the rules that we want to do. So what we need to do is visually confirm, is it doing what I expect? Great. Buy the dip as we've defined it, place our trade, and then go and have some great trades. You know, we want to see results like this regularly because we have this nice production line process. So does that help, folks? That help give you some confidence with the rules, the strategy that we keep using? It's not just me saying, this is a great strategy, you should do this. And again, I'm not asking you for money. If you want to work with me, we can talk about that on another day. But you've got the rules. You know how to find the stocks. I've freely given one of my methods, one of my processes, so that you can go and find, filter, and sort stocks. Let's go to Twitter is our, this is our model example. Buy the dip. This is what it looks like. Buy the dip in a trending state. Let me just get my little widgets. In a trending state, it's in a trend for at least 40 days. It's been going up at the early stage for at least 25%. Again, if we've got an established trend like this, you want to look back over 60 days and say, what's it doing? Is it going up? Yeah, great. Then what we want to do is find the dip, one of these yellow boxes. Is it below the 50? Is it retracing? Is it down 10% in 10 days? Below the 50 or down 10% in 10 days? There's only 4 rules. Those 4 rules. 3 for the trend, 1 for the dip. 3 steps for the trend, 1 for the dip. You know how to find the opportunities. My gift to you. No catches, no gimmicks, no. With my love. Go and do it. It's all I want you to do. I never had anyone to ask when I started out. I had to figure all of this out on my own. What we've done is you've got you can see them there. You've got the top, what have we got there? The top 20 stocks that produce super strong trends. They're exceptional stocks. Stocks like, let's get some of the names. Stocks like Apple, American Eagle, Century, 3D. You've got all of them there. Take a screenshot. Have it with my love. You've got the best stocks. We've validated it with an algorithm. It saves me hours of manually backtesting. I used to have to manually backtest these things just because I'm not a computer guy. I'm not a computer whiz kid. But you know, eventually you find the motivation. You find someone that can do it. So I found someone who can kind of code up my ideas. Great. I'm having a lot of fun with it. It's validating everything that we've spoken about. And there's the proof. So if there's just one thing, if I get knocked over by a bus tomorrow, folks, what you should be able to do is take this top 20 list of stocks and go and trade the trend. So Twitter's our great example. This is a good candidate of buy the dip. It's back below the 50-period moving average. As it goes back above, you're looking for a new entry opportunity. You're looking for that resumption of the uptrend. BYD. Where's my other one? So one of my favorites right now is BYD. We spoke about this last week, if you remember. We spoke about it the week before, if you remember. But this is a good candidate. This is one of the stocks that we like. It's just about at its first target. We've got multiple entries, but this is what buy the dip looks like. And it's buy the dip validated. Rules have been validated on a stock that over the last 20 years has been, in this case, has been a consistent gainer. This is in one of my, again, they're not necessarily exceptional, but they're still exceptional stocks. They're consistently gaining momentum, you know, making new equity highs over the last 20 years. So there's no reason for me not to place this trade. 55 or 54 or 55% of the trades on this stock from memory should produce a winning result. Great. That gives me a lot of confidence for the trade. There's no reason for me not to place the trade. I had this discussion with 1 or 2 people that I'm coaching one-on-one at the moment, and they're finding stocks great. It's like buy the dip. Here's what it looks like. You know this, but most people at this stage, now that they're looking at it, will go, okay, find a reason not to place the trade. Oh, I don't like this, or I don't like that, or I don't like something else. There's no reason for me not to place the trade at this point. We've validated it. It's there. The rules are being proven, irrefutable evidence that it works. on a stock that has historical tendency to trend, and 55% of the time, or there or thereabouts, produces a profitable result. Great, I'm going to take that trade. Thanks very much. Come back tomorrow. Come back next week, see if it works out. So what do you think? Where are you at? Would you like to trade the trend? Do you have the confidence yet to go and do it? Do you finally believe me that this is working? It's not just me talking bullshit every week and saying, oh yeah, you should do this. The evidence is right there. The evidence is right there. So what's holding you back from trading? What questions do you have? Why do you think you can't make this work? What is stopping you from placing, not necessarily this trade, but what's stopping you from placing the next trade? Just some food for thought, some food for thought. So there is my view, my take on trading algorithms. I use them predominantly as research assistants. It gives me absolute confidence. It gives me absolute clarity on what stocks to trade, when to trade them, and to know that, yeah, this is not only a good strategy, but I've got a group of stocks that makes absolute sense to trade. The only thing that we focused on today more than anything is this mechanical scan, the mechanical process, step number one of production line trading. It is the biggest time saver for me. This is the thing that means that we don't have to be flicking through chart after chart after chart for hours every day, wondering if the next stock is going to be the one. It just means that we can zero in on the best stocks, the best opportunities that make the most sense right now. And maybe there's 3 or 4 stocks that today are the best stocks to trade today. Then we can go and visually confirm. Does it look like Twitter, was what we were just saying? There's got 3 or 4 examples. It could look like Boyd Media, BYD. That was one of our example stocks that we went through. But does it look like the model blueprints? Does it match up with like the early stage trend, the middle part of the trend, or where we are right now on Twitter, for example, kind of like an established trend for the last 6 months? And then we can go and pop the trade on. We've got the TTE planning, timeout, target out, exit out. We want to mark off our entry, our exit, our targets. We're going to know that before we place the trade. I'm not figuring it out wondering tomorrow. I know that before the trade goes live because I want to know that. I want to know that. I'm going to put all that information in my spreadsheets. This is what allows me to have absolute confidence, absolute clarity in my own trading. So if you want a little help with this, if you want to learn how to swing trade in the smartest possible way, I'm revamping my mentorship program. And if you'd like to talk about it, you'll learn this process. And we've got several other patterns, several other scans that we use. We're only looking at one of them, and we're only looking at one part of one of the scans. But it's a production line trading process. You can learn it in a very short space of time, typically in under an hour a day. And when you get used to it, this should take 10 to 20 minutes. I've illustrated that many times before in the past. We can focus on the best stocks, the best patterns today to trade, driven by data. We're not making it up. We're proving it. We're validating it. Here's the data, irrefutable proof that it works. We've got a management system, TTE management, which for me, my average return on capital is about 85.76% return on capital. That's my historical average over about 1,300 trades over the last several years with this process. So it's not just a fly in the night. It's not theory. It's backed up by actual data, my own data. And as I said, you'll take about 20 minutes to do this every day. It takes longer to explain than to actually do. You won't be zombie trading. You won't be flicking through chart after chart, wondering if the next chart, you'll just be able to zero in on the next most important trade today. You'll have trade confidence because you won't be stressing over what the market's doing. I didn't know that Biden was announcing anything yesterday or the day before. And to be honest, I didn't care. I didn't care that the market was selling off yesterday or the day before. That was my buy the dip opportunity. I've got great candidates that I can use because of those announcements. It give me an opportunity to get in because we've got a methodical strategy. I'll never read boring company reports because I don't want to do it. I don't like doing it. If you do, that's great. I don't. So you should be able to profit from swing trading in the smartest possible way. You'll have the confidence to transition into the best possible trader that you can be. And if you want to learn this process that we've touched on today, And again, we've only focused on the mechanical scan aspect of one of the trend trading scans that we use. We've got several that we can find that help me find great trades like this every day. And not just me, but like my students find them as well. You know, we've got great feedback from John, from Colin, from Kevin. Some of you are here today, which is awesome. You know, it's a replicatable process, and I refer to it as a production line specifically for a reason, because it can be replicated. If you would like to learn a little bit more about it, because I don't know if what I do is right for you, but let's just start the conversation. We can explore it together. At the very least, I'll point you off in the right direction. Send me an email, phil@antivestor.com, and we'll figure that out together. We'll maybe find some time, hop on a Zoom call, have a little chat. And as I promise you, I'll either point you off in the right direction, or we can figure out if what I do is right for you. And if it is, that's great. We can talk about it a little longer. And if not, that's cool as well. So that's my presentation. That's Algorithms 101. Where are we? There we go. So this is Algorithms 101. How I like to use them. I like to use them as a research assistant. It validates everything that I do, validates the strategy, validates the right stocks, the right time, the right opportunities, and there's no reason not to place the trade. And it means that I can do sessions like this because I'm not stressing over like, where's the next trade opportunity? Oh, there it is right there. Put the trade on, and then I get to talk to you guys and girls. It's awesome. And then what I'm going to do right now is, after I've clicked stop in a few moments, I'm going to go and grab a coffee. I'm going to go to the coffee shop. I'm going to get a takeout. Can't sit in yet. I'm going to enjoy the afternoon sunshine because it's the afternoon here in the UK. And I'm just going to generally noodle around because I don't need to stress over what the markets are doing right this second on a minute by minute basis if they're going up or down. That's the confidence that gives you. It's quite liberating and quite freeing. Anyway, that's my abashed presentation, my little veiled pitch to see if you'd like to join me. And if you do, that's great. And if not, that's okay as well, because I appreciate, like, what I do isn't for everyone. But if you like these free sessions, I'm going to do it all over again next week with a brand new topic. So tune in next week at the same time, same place. And whatever you're up to this weekend, make sure that it involves, well, a cup of coffee, maybe some ice cream.